Hello, everyone, and welcome back to another episode. My name is Jordan. I'm a millennial investor, and you can see that we have our performance updated right over here on the right-hand side on the 2023 version of this chart. So this year in 2023, we produced 18.45% returns versus the S&P 500 in blue, 17.45, the Dow sitting at 4.62, the Nasdaq 32.27, and then we have the Russell 2000 at 6.07%. Now, obviously, this is a big downturn from where I was at over the last couple of months, and this is mostly due to September and August being really negative months for me. But if you want to see my updated portfolio positions, here you go. This looks wildly different than we were at just a month ago, and you can see that we have a lot of position changes, including a new holding, which is going to be a short-term holding, which I'll talk about here in just a second. Now, what I always do in these monthly videos, I talk about where I'm at, and I'm actually going to go ahead and update this to September, now since it's as of 9/1, and this shows my portfolio holdings and what I'm planning on doing over the next year. So let's go ahead and jump right into it. And if you haven't seen me before, I'd invite you to subscribe. I have mentoring sessions for those of you that are new to the stock market that are interested in learning from someone who's been in the game for over 5 years now and has made pretty decent returns. I'm still a newbie. I'm still learning. I'm not a professional by any means, and it's not financial advice. But if you want some starting points and you want some help getting started with your investing journey and avoiding a lot of the mistakes that generally a lot of newer investor makes, these are where you can start. So go ahead and sign up for that if you're interested. But other than that, let's go ahead and get started. I want to start with the smallest position and work up from there. So if you look here, Walgreens is a brand new position that we bought just a couple days ago, which I'm filming this on September 10th, the day that you're watching this, and this is September 6th as of the day that I bought these shares, so just 4 days ago. Now, I bought 500 shares, and I intend on this planning on being a very short-term holding. I don't plan on holding this for the long term, but there's a couple reasons why I own the stock, and the first one is the company has gone down significantly in value. If you look just over the last 5 years, it's went down 68%, and just over the last 1 year, it's down 39.97%, so about 40% just over the last year. But meanwhile, the company's revenue and profitability has actually not been that bad. Let's go ahead and take a look at that. If you look at its revenue, it's pretty much at all-time highs. Last quarter, it put up $35.42 billion, and that represents 9% growth year over year. Let's look at profitability. This is the issue that is going down. You can see that revenue is going up, but profitability is heading in a big down way. And that's one of the big reasons why this company is starting to see its share price falter. Now, this is not a company that I would say is the most premium quality. I will note, however, if you look at their long-term debt, it is generally going down. That nasty long-term debt is getting more and more sufficient from a balance sheet perspective, and that gives them more money to reinvest back into themselves. But that's not so helpful when the company is not even producing profits again in the first place. Well, the way I look at it is that this company is reaching such low valuations at $19 billion that it's starting to reach prices of simply levels of book value. You can see price to book right now is about a 1.1, which means essentially if you sold the entire business and just sold it for cash, so if you sold all the locations, all their products, and just liquidated it in a cold hard cash, that's around what the stock price is worth right now, around the $20 a share range. So at this point, even if Walgreens doesn't really have some big uproar and boom in business, this is only a very short-term trade. Don't be surprised if next month when you return, this position is gone. I expect to sell out right very close to where I bought in at. I'm honestly trying to generate some options income, which is why you can see I'm selling weekly options. I sold $141 worth of contracts from my 500 shares, and I expect to hopefully generate $100, $200 a week every single week that I hold this, and maybe try to sell out for a tiny profit. I don't expect this stock to roar up to $25, $30, $35 within the next couple of months. I'm honestly expecting it to kind of hold flat, if maybe not a slight uptrend, but that's why I'm holding this company far different than the other three positions that I'm holding. Next, let's go to the second largest position, and that is in red here, and that's PayPal. And PayPal, we have increased our position a little bit. If you look at the purchase history here, back in August 16th, we did buy another 100 shares, and that was at a lower price than the rest of these. We were originally buying our shares at around $63 and $66, and then we bought another 100 shares just below 60. We bought it at 59.65. And this brings our long-term, our total cost per share at 63.3 average. Now, right now, the stock is trading at 60.98. And let's go ahead and look at PayPal stock over these last couple of months and over the last couple of years. Now, if I pull up PayPal here and you see their stock chart over the last year, it's still down 37.55%. Now, if you look over the last 6 months, it finally bottomed out back in August. I think it was actually the day before. Yeah, right before this stock bottomed was the day that I bought my shares, the 16th. So I should have waited one more day. Could have got it $1 or 2 cheaper. But nonetheless, since then, we started to see an uptrend. Let's go ahead and zoom a little closer here. Since we've seen this downtrend down to $58 a share, we've started to uptrend back into the 60s, and now we're bottoming out right around 61. Now, forget the stock price for a moment. I want to talk about the actual business because that's what matters in investing in a stock like this. The revenue growth has been consistent as ever. Even if you look over the last 5 years, that's a more recent time, you can see it's just slow, steady, consistent growth. On a longer term chart, obviously, it looks a lot prettier, but that shows a longer time horizon, and we're not focused so much on the past, we're focused on the future. Now, profitability. If you ignore this one quarter, the most recent quarter, that is due to a one-time cost, a one-time write-off of about $1 billion from this company's buy now, pay later loans. So you can kind of ignore this one-time free cash flow number because it's not really relevant due to a one-time write-off. However, if you ignore that one-time number, you can see that the company's pretty much flattish over the last 5 years. If you go ahead and let's zoom into the most recent years, you can see it stays right around $1 billion every single quarter. Now, profitability is not quite to the level I'd like it to be. I'd really like to see this reach past $1 billion each quarter, get to 1.1, 1.2, 1.3 billion. But if you look at this company's market cap, right around $67 billion, and you divide by, say, an annual cash flow of $4 billion. Now, let's go ahead and look at this company's free cash flow over the last several years, and you can see that this company generally produces right around $5 billion in free cash flow every year. But let's say that this company does $5 billion. So let's pull out our calculators here. You take 67, which is the market cap right here, what I'm highlighting on my mouse, 67, and you divide that by 5. That means this company's price to free cash flow currently trades at about a 13. So the price to free cash flow of 13 is far below the average in the market, and its PE ratio right now is estimated to be around 15 as well, so also below that in the market if you're someone who likes to look at net income estimates and then EPS estimates as well. Now, this company is starting to buy back lots of shares, so even if the stock price doesn't go higher, the stock price is starting to go down over time, the shares outstanding is starting to go down over time, because we reached a peak here back in 2021 at around 1.19 billion, and we've since started to see a downtrend in recent quarters down to 1.11 billion, which represents a 3.8% downturn in shares outstanding, which of course increases your ownership over time in PayPal stock. But with PayPal, this company just got a huge cash influx that they should be getting any day now from their recent buy now, pay later loans. So when you look at their cash pile of 10 billion, it's likely somewhere closer, probably to somewhere around 12 billion. We'll see in the next couple of months or so. And their long-term debt is now actually going to be lower than the cash pile. So when you consider that this company's cash is around 12 billion, the long-term debt's around 10.5, this company's going to have a much healthier balance sheet over the next couple of months. And this company's profitability, I think, is going to go from the stagnant 1 billion per quarter or so and uptrend towards new highs. That's what I'm projecting from the uptrends in this business that I project over these next couple of months that I've talked about in previous videos, from their Braintree growth, from their Venmo growth, and honestly, even their old school branded PayPal has started to uptrend as well, which is a bit shocking to me. Now, PayPal is one that I intend on owning for a while. I don't plan on selling out this year. I would probably exit my entire position around closer to $100 mark. It's not the most profitable or fancy or sexy looking business in the stock market, but it's one that I really like at these valuations. Next, we have Dropbox, and this is one I've talked about so many times. This is the only really big position that we're still up a lot on that I haven't sold out of recently, which I should probably go ahead and show where we're at for the year. We're about break even in terms of booked losses and gains. We've had a couple of big gains back here in February, and as well as the last couple of months like July and August, but we've had some huge losers like in June, and then this month in September with some big losers. And if you want to just scroll through, I'll just show very briefly some of my positions, and if you want to pause it as you go along, this shows every position that I've closed so far in 2023. All gains, all losses, and a lot of these are option contracts, but there's of course some stock sales in there as well, so if you want to take a look, there you go. But nonetheless, next we have Dropbox, and this is a company that I love because they just chug along and they do exactly whatever they want to. And honestly, they're often overlooked because they're a very boring business. However, they're one of the most consistent that you can find in the stock market. Consistent revenue growth, quarter in, quarter out, and it doesn't matter if we're looking at international or if we're looking at the United States revenue. It's pretty much as consistent gets. Over the last year, we've had 8.7% growth, and profitability took a one-time hit, just a one-time hit due to their layoffs. They paid a lot of severance packages for people who are being laid off the company. So they're going to get more profitable, and this one-time downturn of 10%, similar to PayPal, is due to a one-time cost. I project that next quarter, they are likely going to put up the highest free cash flow number they've ever produced. I would project a minimum of $250 million in free cash flow. I think it's very likely that we see 260 or maybe even 270. I'd be very shocked if they don't break past this next quarter's high at around 245. I'd be really shocked at that. But the cool part is, even the more extreme version than PayPal, which is why I've owned so much of this company, is this company's buying back stupid amounts of shares. Around 6% within the last year, and you can see from 2020 they've really taken a case towards buying back shares. 420 million shares outstanding was the peak for this company right around 3 years ago exactly, and then went from 420 million all the way down each and every quarter to 343. Now, if you go back to 2020, let's look at this share price. You can see that since this company went public, it's traded around the $20 to $30 range. And if we go back to mid-2020, you can see that this company was around $22, $21, somewhere around the low 20 range. And today we trade around the mid to high 20s, 26, 27, so it has gone up some. However, if we zoom in a little closer, you can see that 2021, this company was already reaching highs around $32, $33. So we're still far below the highs. And if you look at the revenue estimates and profitability estimates for 2021, in the middle of that year, we were producing around 570 million in revenue, and now we're doing 620. In terms of profitability, you can see that during the couple of months during the summers of 2021, we were producing around 220 million or so during the peak. And other than this one-time cost, and this kind of throws off the numbers for this year, we're about to see record numbers, but last year we were beating those estimates, reaching the highs of 245 at one point. So I think that this is a company, while shares have continually been bought back, while this company has continued to grow revenue and profitability, it's just one that's a steady chugging away stock, and they're projecting around 840 million in free cash flow this year. Now, if you take 9.44 billion, okay, and you divide the 0.84 in free cash flow in billions this year projected, they're at a price to free cash flow at around 11. And 11 is not extremely expensive for a company that is growing revenues consistently in the high single digits and profitability over time as well while buying back shares. This is one that I expect steady, slow, consistent growth from. I would like to exit my position entirely around the $35 a share range, which is exactly why I have covered calls right here for 300 of my 700 shares at around 30 and the remaining 4 out of 700 selling at 35. So I expect to sell around half of my position around $30 and then the other half of my position around 35. That's what I'm anticipating for Dropbox stock. Next and last on the list, we have Crocs. And this is one that, while I did make a lot of money earlier this year, if you look, actually, it's the top of my list. This year, we booked $13,600 worth of gains from Crocs stock, and I was able to buy a lot lower. So when I sold out of my position fully this year, I sold it, I believe it was $142, if I remember exactly. But looking at the pie chart here, you can see it represents a massive part of my portfolio at 36.5%. And Crocs is one that I just see a business that is going higher. Let's ignore the stock price. Okay, this is the stock price performance over the last year, 5 years, 10 years, whatever. I don't care. Let's not talk about the stock price. Let's talk about the business. What is its revenue doing? Seems to be doing just fine, reaching all-time highs and projected to continue to go higher into the next year. Okay, so all-time highs on revenue. What about profitability? Well, just 2 quarters ago, we put by far the highest free cash flow number this company's ever produced, and as well as last quarter, we produced the second highest free cash flow quarter we've ever produced as well. I project finishing out this year very strong. Something else I would mention is that while these free cash flow numbers have been coming at record levels, this is while this company is trying to pay off massive loads of debt, which is costing them a ton in interest. But each and every quarter, the debt is going down very quickly. If you look at the most recent quarter of 1.95 billion and compare that to the record high 2.8, you can see that they've reduced their long-term debt from their highs around 30% just in the last 5 quarters. So they've taken off 30% of their 2.8 billion in debt just within the last year or so. So this is the interest going down big time. And something else I would mention is that they did just refinance their interest rate on a variable rate loan. So already they're getting 50 basis points lower in interest than they were getting charged just before this refinancing a couple months ago. But not only that, if interest rates were to come down, they were to steadily get decreases in interest costs over time. And regardless whether they have a high interest rate, a low interest rate, as they continue to pay off more and more of this long-term debt. And let's actually go ahead and zoom in here because this will probably give you a better idea. Let's go ahead and take these off and give you an up close. As they pay off more and more of this debt over time, this will give you a better idea of what this company's big picture will look like in terms of its finances as it gets healthier and healthier over time. But furthermore, this company did buy back shares for a long time up until recently it stopped. It went from around 72 million and it decreased down to here around 60 million, representing about a 20% decrease in shares over the last 2 years. And then they bought out Hey Dude and they couldn't buy back shares anymore. Well, the company announced back in July that they're starting to buy back shares again because they're starting to get healthier balance sheets and having more cash on hand and getting more profitable. But this is not only a company that looks better in terms of its financial statements, it's one that in my opinion is starting to look a lot better in terms of Google trend searches as well. Now, this is the last 5 years for Crocs, and if you look at just the US, it looks kind of flattish. If we actually, let's go ahead and expand this, and let's go ahead and compare just over to 2022 versus 2023. So let's look over the last year or so. And let's see, you can see during the time period of January and going into the time we're at now, let's look at July, August, September, the third quarter. So July starting right around here, up through September, which ends right around here. You can see the 2 points where my mouse is at. The average between these two is probably around 75-ish, low 70s maybe. And you can compare that to where we're at now. Let's look at the third quarter so far for this year. July 1st starts right here, up into where we're at so far for September. We still have a couple weeks left to go, but you can see the average for this point is probably somewhere around 75 to 80. So we already have comparisons higher to where we were at last year, but really this gets interesting if we look worldwide, not just the United States. So if we look worldwide over the last 5 years, you can see that this company is pretty much at all-time highs. They were at all-time highs just a couple weeks ago, and this is far beyond where we're at during the summertime last year, reaching peaks at around 75 or so. Now we're in the hundreds and even downtrending, even to the 80s and 90s, which is far below where we're at during September last year, being around the 60, 70 range. Now, if you look over once again over the last year or so, let's go ahead and do the same thing. Let's just look at 2022 versus 2023 worldwide. You can see the third quarter starts right about here around July, starts right around this period, right around 72. And if you look throughout the third quarter, you can see that the average is around, probably 70, 65 to 70. And if you look at the average now this year, July once again starts right around here. And the 90 is where it started and 78 where it ends. Average looks around 90 or so for this, even including that peak of 100. So overall averages are higher. Now, if we do one more thing, let's go ahead and do this exact same thing, but I want to look at it for Hey Dude. And let's go ahead and see how this company, Hey Dude, has done over the last couple years. Well, really recently, over the last couple months, I'm not sure what's going on, but the trend ever since 2023, and especially in these last couple months, Hey Dude trends is really starting to look good. Now, normally we see huge peaks during the late November stage for this company, and that is primarily coming from Black Friday. They have a huge Black Friday sale every year, and you can see this huge spike here in 2021, reaching 93 on this charts. Now let's go ahead and look during last year, during Black Friday, they reached their all-time high right at their 100 range. But something you'll notice here, this huge spike up recently, that is not at all during Black Friday. That's just a regular June-July period. This company reached massive search levels recently, but even if we ignore this anomaly, let's go ahead and forget that most recent search history, and let's go ahead and actually zoom in over recent time periods. Let's look at where this company was at once again during quarter three. Quarter three starts right around here and then ends right around here where my mouse is at. And once again, you can see the average for this is right around 45 or so. We have a little peak, then we have a trough. Average is probably around 45 or so in search results. Now let's go ahead and look to see where we're at today. Let's go ahead and go to where July starts, right at the 100, right at the peak. And then today we're at 76. Average, just looking roughly in the middle between these, we're at around maybe a 70 a 70 or so on average, where over here we were a lot lower. We're around a 60 average. So Hey Dude is doing just fine, and that's on worldwide basis. And even if we look at this on a United States basis, let's go ahead and look at the time range over the last year or two, and it looks pretty healthy here as well. Let's go ahead and take a look, and you can see that the average last year is a lot lower than the uptrend we're seeing now, reaching near all-time highs, and I can't wait to see what this company's going to do during Black Friday this year. So overall, Crocs is one that I see that's doing just fine. I am down on my position, big whoop. It's a big holding of mine, but I think it's going to do great long term. I think it's going to go pretty close towards the $100 plus range towards the end of this year, but I think really 2024 is going to be hopefully the year that takes this company into a new level. But other than that, guys, thank you so much for watching. Check out the stuff down below if you're interested. But other than that, I'll catch you all next time.